I'm really excited today that we're gathered here to celebrate the most recent book of Lynn Stout, who since joining us last year has been the Distinguished Professor of Corporate and Business Law at Cornell. Her work, The Shareholder Value Myth, How Putting Shareholders First Harms Investors, Corporations, and the Public, makes a series of succinct and I believe devastating arguments against the idea that corporations' prime directive should be that of maximizing shareholder value. In doing so, her book has garnered attention from most of the major media outlets. Called in the Deal Book section of the New York Times a, quote, slim and elegant polemic, The Shareholder Value Myth occasioned musings in Forbes about whether the tyranny of shareholder value might finally be ending. Many members of the corporate law community have written or blogged about the book and its impact. This is not Professor Stout's only book. In addition to the case book she has co-authored, she published Cultivating Conscience, How Good Laws Make Good People just 2 years ago. We are honored to have here today three extremely distinguished professors of corporate and business law who have graciously agreed to comment on Professor Stout's book and on its central idea. I will introduce each of them as well as Professor Stout herself briefly before turning the floor over to them for presentations of approximately 15 minutes each. That will be followed by a more general Q&A, which I will be moderating. So the first of our speakers will be William Bratton, who is currently Deputy Dean and Nicholas F. Belliccio Professor of Law, as well as co-director of the Institute for Law and Economics at the Penn Law School. He's recognized internationally as a leading writer on business law and brings an interdisciplinary perspective to a wide range of subject matters encompassing corporate governance, corporate finance, accounting, corporate legal history, and comparative corporate law. His work has appeared in way too many law journals to enumerate, as well as and he's also published a book on corporate finance, cases, and materials. In 2009, he was installed as the Anton Phillips Professor at the Faculty of Law at Tilburg University in the Netherlands, and is the 5th American academic to hold the chair. Next in our sequence is James Cox, who is Brainerd Curry Professor of Law at the Duke Law School. In addition to his text, Financial Information, Accounting and the Law, Cox and Hazen on Corporations, and Securities Regulation, Cases and Materials, he has published extensively in the areas of market regulation and corporate governance, as well as having testified before the U.S. House and Senate on insider trading, class actions, and market reform issues. His corporations treatise won the Association of American Publishers National Book Award for Best New Professional Scholarly Legal Book in 1995. He's a member of the American Law Institute, as well as the ABA Committee on Corporate Laws, and a past member of the NYSE Legal Advisory Committee. Our final speaker is from the University of Chicago Law School, and is Professor Todd Henderson, who graduated from Chicago in 1998 and was elected to the Order of the Quoit. Following law school, he clerked for the Honorable Dennis Jacobs on the Second Circuit Court of Appeals, as well as practicing at Kirtland & Ellis in Washington, D.C. His research interests include corporations, securities regulation, bankruptcy, law and economics, and intellectual property, and he's published widely on each of those areas. Our final speaker really needs no introduction because it's Professor Stout herself, but I will introduce her briefly. She's an internationally recognized expert in the fields of corporate governance, securities regulation, financial derivatives, law and economics, and moral behavior, and has written numerous articles and books on these topics. She also serves as independent trustee and chair of the governance committee for the E.E. Vance family of mutual funds, as a member of the board of advisors for the Aspen Institute Business and Society program, and as executive advisor to the Brookings Institution Project on Corporate Purpose. So without further ado, I will turn the floor over to Bill Bratton, who will begin.
I'm delighted to be here to celebrate Lynn's book. She gathers up a lot of points she's been making over many years here, and presents them, I think, in a succinct, accessible, and forceful single volume. Now, I haven't site-checked, But my sense is that the book also turns up the heat. That to the extent there were any points of equivocation in the predecessor work, they've been reconsidered and readjusted here. This is a book that goes for broke, and that's a good thing. Lynn and I aren't all that far apart on matters of question. But you know, it sometimes does happen that when two observers broaden perspectives as they get closer and closer, the differences between them show up in ever bolder relief. And that certainly was my experience in as a reader. I entered many caveats and made a lot of objections in the margins as I went along. But after I finished, the question that lingered in my mind was whether any of that mattered. Whatever objections I noted in the margins, exactly how did my views differ from those of Lynn, and were the differences important at all? So answering that question actually took some working through on my part. And I'm ready to report to you this afternoon on that matter. The book builds on two big assertions. First, that shareholder primacy gets corporate law wrong, and second, that shareholder primacy gets corporate economics wrong too. I'll start with the first assertion. Lynn says that shareholder primacy is a fable, traceable to overly broad readings of an old case called Dodge against Ford Motor Company. The law, she says, doesn't require shareholder value maximization, which is just one of a menu of possibilities. Managers just have to do their best in good faith for the business. I agree that the law doesn't require shareholder value maximization, but I disagree as regards the further point that shareholder primacy has no place in corporate law. Shareholder primacy is a confusing eye in the beholder sort of concept. Part of the confusion stems from the statement of the basic principle. It comes in different versions. Let's start with a bland, undemanding statement. The corporation should be managed for the shareholders' benefit. From there, you can start dialing it up. You could say that the corporation should be managed to enhance shareholder value. At that point, you could dial it up yet another notch and crank in the maximand. You could say the purpose of the corporation is to maximize shareholder value. Some even go a step farther than that and say that the purpose is to maximize the value of the stock today. So there's a range. And it seems to me that when you're talking law, duties, that there's a big difference between words like benefit and enhance and a word like maximize. Maximization is not a legal concept if you think about it. It makes sense only when confined to its home territory in economics. It would border on the absurd to say that a corporate manager had a duty to maximize anything, whether for the shareholders or for anybody else, because for a going concern, there is no way to verify the maximal result. The only situation in which the notion might even be entertained is sale of the company, termination. And the Delaware courts did briefly flirt with it there, but they sensibly stepped back as the fact patterns unfolded over time. So I agree. I also agree with Lynn that corporate law holds out plenty of elbow room for boards of directors making distributional decisions. The Lynn Stout mediating hierarchy concept of board of directors is both descriptively accurate and normatively appropriate. But I don't think that Dodge against Ford is irrelevant, or that the legal statement of corporation or corporate purpose lacks a notion of shareholder benefit. If Dodge against Ford came up again today in Delaware with exactly the same arguments on the table, it would come out the same way. But of course, the whole point is that the case would never come up again with the same arguments on the table. In a replay, the defending board would cloak its managerialist objectives in the language of long-term shareholder value enhancement. And so long as management backs its shareholder lip service with a record and isn't self-healing, its allocational acts are indeed covered by the cloak of business judgment. But Management is privileged to wear the cloak covering its allocational nakedness, only if it's ready to acknowledge the shareholder interest. When challenged, it must genuflect at the shareholder level. The ritual has performative value. Management offers its obeisance quite voluntarily because it emerges with its own legitimacy enhanced and also its power. Meanwhile, ambiguity prevails in the legal framework. Constructive ambiguity. The issue is between shareholder and constituent interests is never joined. No manager wants that to happen. And remarkably, we've gone almost a century without a shareholder having pushed a manager into the corner to join the issue on an allocated decision, at least outside of the context of defense against the sale of the company. So, there it is. Such is the genius of American corporate law. Let me nonetheless join the issue this afternoon. I've got a hypothetical. A manufacturing firm employs skilled labor, high value added, premium price, secure market share for the product. Miraculously, a technician at the company invents a new machine process that can do much of the work done by the skilled laborers for a fraction of the cost. The new process can be kept secret if the company so desires. If it is deployed, the company will fire half of its workers and double its stock price, even as its revenues stay exactly the same. Alternatively, the company can hold on to its market share and its revenue stream, but retain the workers and suppress the technology. The question is whether a board of directors that decides to suppress the technology breaches its fiduciary duty to the company. I predict it would be held to have done so if it suppresses. The decision to suppress would at a minimum be deemed antithetical to the company's best interests and in bad faith precisely because it sold out the shareholders in favor of labor. Not that I expect such a case ever to come up, but if it did, it would go the shareholders' way. And here's the reason. All right? When it comes down to brass tacks, and in corporate law, brass tacks is labor versus a corporation. Corporate law is a capitalist tool. Do you agree, Lynn? Now, Lynn. Second dessert. The shareholder primacy gets corporate economics wrong, too, taking aim at the Jensen and Meckling agency group. The book tells us that shareholders do not own the company, and that managers are not agents of shareholder principles. This is absolutely correct. Shareholder primacy is juridically inaccurate. Director and officer duties are owed to the entity, and the legal model resembles trust as much as it does agency. This is not due to some corrupt management influence. It's not just form over substance. Corporate law evolves in a competitive context. Either it's robust so far as concerns facilitation of business on the ground, or it shape-shifts quickly to become robust. Public shareholders don't own and aren't principals because their own ignorance and stupidity disables them from being put in the position of instruction givers, quite apart from any collective action problems under which they may live. So far, so good. We agree. But the book goes a step further, asserting that shareholders aren't the corporation's residual claimants. And here, it just gave me a jolt. Lynn says that speaking legally, the shareholders as residual claim is just as trite from bankruptcy law. The reality, she says, that shareholders don't own the residual because they can't declare dividends. You have to wait for the board to do it. If management suboptimally retains earnings, the shareholders lose, and there it is. She concludes that the corporation is its own residual claimant, sort of like Cornell University. I don't buy it. Residual doesn't tell anybody what to do. It just assigns results. If management dissipates the asset for the benefit of the employees, the shareholders take it on the chin precisely because they have the residual. It's the inevitable economic result of the legal model, not just an incidental result of bankruptcy. Take out any state corporate code you like, And it provides that in the event of liquidation, all contract counterparties get paid first. That is fundamental to the legal model, and it antedates benefits. So I don't accept the chapter claim. But Lynn and I still aren't really very far apart. So I'd like to take the occasion of my visit this afternoon to see if I can reach Lynn's destination without having to claim that the residual isn't residual. Toward this end, I'd like to back up past Jensen and Meckling to the point at which the first fundamental theorem of welfare economics gets extended to corporate law governance. You get the following assertion. A system of corporate governance or law is ex ante efficient if it generates the highest possible payoff for all parties involved. All parties. Shareholders, creditors, employees, clients, tax authorities, and any third parties who are affected by the corporation's activities. This assertion is completely uncontroversial as a matter of economic theory, even though it affords full recognition to constituent interests. To get shareholder primacy, you have to take two further assumption-related steps. The first step comes from Jensen and Meckling. They posit that if we model the firm as a nexus of complete contracts among all parties involved, except for the contract between the firm and its shareholders, which we will model as incomplete, then maximization of shareholder value is tantamount to the economically efficient result. This assertion is literally true. If everybody other than one incomplete contract holder has a complete maximizing contract, then everybody other than that one incomplete contract holder is already maxed out. And maximizing for that remaining one claimant is economically efficient by definition. That's all Jensen and Meckling said. It left open a wide theoretical door for proponents of constituency interests. For nothing stops them from making efficiency arguments from the point of view of contractual incompleteness. And constituent contracts are incomplete. All contracts are incomplete. This creates a problem for shareholder primacy, whose proponents have to show that other constituent incompleteness does not disable their case. Shareholder proponents address that burden with three familiar points. First, relatively speaking, shareholders are more vulnerable. Second, decision-making costs should be minimized, and a multi-constituent model imports incoherence, which would add to decision-making costs. And third, the shareholder interest is the residual interest and provides a superior management reference point. For most people in my field, these points carry the authority of Scripture. But just how strong are they? First point, shareholders are more vulnerable than other constituents. That resonated deeply a quarter century ago. But now, shareholder empowerment has become a fact on the ground. The shareholders' one point of direct intervention in governance, the vote, was a joke 25 years ago. Today, it carries clout. And with managers now incented in the shareholders' direction with equity compensation plans and the M&A market operating without significant structural barriers, shareholder vulnerability is no longer of convenience. Reverse effects from shareholder empowerment now are just as big an issue. Indeed, I would join in with Lynn in arguing that that's the primary issue today. The second point, that a shareholder maximum imports governance coherence and reduces decision-making costs. I think that might matter if the issue were whether to challenge the inherited legal model to substitute some sort of a formal stakeholder issue. But I don't think it registers as a problem when we're looking into maximizing for the corporation within a zone of constructive ambiguity with the shareholder franchise operating as an ultimate check. Indeed, I see the coherence argument as a paired opposite with Lynn's disavowal of primacy in law. Lynn says that because there's no constant duty to justify everything in shareholder maximizing terms, there is no primacy in law. The shareholder side says that absent the duty to justify everything in shareholder maximizing terms, we will lapse into chaos. I disagree with both. Which gets me to the third point. That the shareholder interest as the residual interest provides a superior management reference point. And I think this one's the rub. It's here, I think, you find the motivation for Lynn's contention that shareholders don't hold the residual. If that weren't the case, this point would just go away. But I don't think that's going to happen. At the same time, the more closely I look at this point, the less it impresses me. Not that there's anything wrong with it in theory. Accountability presupposes metrics, and the residual return is an obvious candidate for that. Okay, sure. But if you transpose this point into practice, what you end up with is a mandate to manage the market price of the stock, which is the real-world instantiation of the residual. Sometimes doing that is excellent business policy, while at other times it's a terrible idea, as Lynn explains at length in the book. Managing to the market price is the logical conclusion of everything in shareholder primacy, and the reason why shareholder empowerment in the law is a terrible idea. So, if there's any cognizable space between Lynn and me, it's more theoretical than real. Which leads to my final question for Lynn. If we could denude shareholder primacy of its agency cost-based urgency and get the ill-conceived shareholder empowerment agenda off the policy table, would you accept a restatement of the shareholder plan that the purpose of the corporation is to enhance long-term shareholder value?
Well, before I start sharing my remarks about Lynn's excellent book with you, I want to tell you that today is one of the notable achievements of my life. I went outside this building to use my cell phone, and I was able to find my way back to the dean's office. A rabbit warren, so I had a great tour on the way. 2 hours later, I did reunite with my two co-teachers. I felt pretty good about that whole process. I actually share, so coming out the same place that I think Lynn would like to come out, and that is that one of the first step is debunking the metric by which we're going to evaluate whether the firm is performing well, and getting that off the track of whether it's maximizing or increasing profit for the shareholders. I think that would be a nice prophylactic effect, because I think that would then allow us to kind of be more holistic in looking at how the firm, what is the firm's mission and how it's performing. And I think the real goal of Lynn's book here is to get to something that she and Margaret Blair have written about, and that is that what is the role of the board of directors. That you're not thinking about getting rid of this body, but thinking about what the mission of the board is. And it's what Lynn and Margaret refer to as a mediating role, in which you find that a corporation, as Bill was talking about, has lots of different stakeholders in it. And you find that the central nerve body, being the board of directors, is to try and mediate. And that would carry out where Bill wound up, I believe, which is thinking about how do you make this firm be sustainable and be valuable, more valuable in the long term, not just thinking about managing to the earnings today. And I think one thing I noticed when reading the book, I thought, well, okay, so this is a monograph and it's got limited space, and Lynn does point out that one of the bases for thinking that the shareholders are not the owners is that corporate statutes say that the affairs of the corporation shall be under the direction of the board of directors, not the shareholders. And shareholders have very limited powers in being within the corporation itself, and very limited ability to do anything about influencing the board. You know, one can even go further than that and think about lots of other ways that there's something going on where you think that a lot of corporate law today is focused on trying to even minimize the role of shareholders even more. Super voting comes to my mind, as one of those. You know, the big one is that who nominates these directors on the board? They're self-nominating, and the process is still that you never put somebody on a board of a public company without sort of vetting that initially with the CEO. I've been in that process repeatedly, and you don't put somebody on the board that's not going to, the CEO isn't going to be comfortable with. So it makes us realize that the shareholder's role is vastly circumscribed, and seriously circumscribed, and limited, and so they don't look like real owners, that they're just sort of, and then you think about the transitory nature of so many of these shareholders, about what their length of holdings are, a few months, a couple of years. It's not the same thing as when you own a house or something. So what's your emotional attachment, particularly when you realize that the only role this plays in your portfolio is what impact it has on the overall risk of the portfolio. Because the firm-specific issues can maybe be diversified away. So there's lots of things there that question the kind of ownership model. And then we start slipping over and sort of thinking about, well, gee, then who's really running this company? You know, we have the maximization, how important a role that is, and I think that's very problematic. Otherwise, I think, Lynn, you might be taking on something that is more risk on the ground than we really think about. My perception is that the boards of directors are kind of not getting the job done, generally, for all corporations. I think there's lots of reasons to look at that. They tend to, for example, one area I've been focusing on a lot lately is financial reporting. And so we find that corporations hate to pay their auditors more money, and they're really resisting steps and activities that would not only make the financial information reporting system more trustworthy to the executives, okay, not to mention that it would be more transparent and useful to investors. They resist that tooth and tong. So and that's, you know, we think, well, the statistic is that the board's really doing a good job, because look at what's happened to CEO turnover. The half-life of the CEO today is something around 6 or 7 years, and before that it was probably twice that, maybe 15 years ago. You know, one could actually look at that statistic and say the board's not getting the job done, because if they're getting a good job done and hiring people, maybe you wouldn't have the CEO having such a short tenure. Otherwise, there's something that explains why the CEOs are turning out faster and faster, and it may be some problem with laying there. We learned out of the financial crisis that stock options are a bad way of compensating people because it's excessive amounts of risk. And all corporation boards were then stepping out and going to something called restricted stock. But when you look at these restricted stock plans and the various disclosures that occur in connection with them, you find out that there's state valves, so that they really are just name only having these restrictions on them and not effective. So when you look at this, we start thinking about, well, gee, who is the company really being managed for? Is it really to produce the profits and the gains to the shareholders, or something else? And for some reason, when I start asking that question, I keep coming back to myself thinking about Goldman Sachs. I keep thinking about Goldman Sachs because, and as Warren Buffett said it, what kind of business model pays out 40% of your revenues to the senior executives of the firm? I mean, if you really thought that this company, Goldman Sachs, was being managed for its stockholders, which includes Cornell University, it includes Penn, it includes Chicago, and of course Duke, okay? Which had a bigger endowment than any of those schools, by the way. That the effect of that would be that you would say nonsense. You're not going to pay out 40% of our revenues and bonus to the people who draw a paycheck around here. That should be to the owners. So, you know, maybe this idea about the shareholder primacy model is in fact a myth. It doesn't have any traction on the ground. That's the one of the questions I have. But, you know, be that as it may, we can make a stronger case for debunking it. But let's assume, where does that lead us? That leads us to the mediating board. Bill hinted at this, and I'll lay it out maybe somewhat different. My concern about the mediating board is, one, we may already be there, okay, and not know. And two, that if we're not there, then what are going to be the metrics by which we decide whether those making decisions are doing it in a socially optimal way? What's going to be the checks? What are going to be responsibilities for that? If we have the mediating board, and it's going to mediate the various stakeholders, let's just say we have the people who, the shareholders over here, and we have the bond claimants over here, and we have the suppliers here, and we have the customers there, and of course, don't forget about the workers, okay? When you start thinking about those various groups, and they all have interests, but they're interests that sometimes conflict with one another. Just stop and think for a moment, who's got the greatest firepower to have their voice heard? If you just think about interest group politics, and within an organization, where are the levers? So one idea would be that the next step, if you're going to have a mediating board, is to think about all the changes that you would have to make within the corporate structure. I'm not saying we shouldn't think about that, but the changes would be profound, okay, in the corporate structure to be able to allow a board to really prefer, in some transparent way, hopefully, one interest group over another, because I think at the end of the day, the Carl Icahns, the Colbert, Kravis, and Roberts, and you name them, okay, are going to mow them right over. Because not only do the existing levers all favor them, but they want to grab that lever and yank on it and eject whatever the management of the board is, they can grab it. But they're the ones that have the marbles. It's very hard for me to think that, for example, one of the stakeholders could be the community. What is the community for Cisco? Is that California? They have 4 plants in Durham, North Carolina. Anybody ever been there? 4 plants. Does Durham have a say there? Does California? California's got a lot of Cisco plants, but it certainly is a minority where its plants are located. So where is the community? Then you start thinking about the community. I don't know if you've had any dealing with county and local governments and at the state level. It's really crazy to find out what kind of laws and interests they're able and willing to respond to. Most of the state takeover laws, okay, have been responsive to 1 or 2 corporations in a particular state, and they've been very hostile to the interests of investors, and sometimes I think could be even hostile to the interests of labor. So, when you start thinking about these stakeholders and who they're going to be, that's problematic. And then I'm going to suggest to you, well, we have some models around the world where stakeholders' interests are actually advanced. In Northern European countries, particularly the Scandinavian countries, that you have co-determination. You find in the Asian Rim countries that you have a symbiotic relationship between labor and capital interests frequently being reflected in the board. And just to mention you that that's not American. Okay, I'm not saying it's un-American, but we're the melting pot, and I think the success of so much of the what you find in the countries such as Scandinavia and Asia is a result of the high degree of homogeneity within the culture that allows these interests to get reflected. Back out of that, what are the values of America when it comes to in the marketplace? We would rather, I believe, have cheap toothpaste, okay, rather than define that the people are being paid a living wage. Now, if you agree to any part of that statement, then how well are we going to be in being able to mediate the interests, okay, the economic interests of owners, okay? How are we going to put owners in quotation marks over, okay, the interest of paying a working wage? I don't think it's going to work very well. Then you add in the pressures that's going on in society today. And that is, you go down the list, it's hard to read the financial section of any paper today without hearing about how underwater the various public, private pension funds, the problems that insurance companies are facing to try and feed their annuities. They're all looking for high returns. And they need those high returns. And we're getting into an era where that's going to be, we have a graying population, a growing demand, and you have huge demand for high returns, makes it all the less likely that if you get into a mediating board situation, that somehow the interests of consumers, that the interests of workers, okay, or the interests of the community are going to prevail in the face of that. And our society would have an interest in thinking we want to boost returns. Then complicating all of this is not only do we have an aging society, we have a society that is increasingly machines replacing workers. Okay? So, the efficiency that's been introduced by the computer and other operations will build in demand on private organizations to produce returns of some form to take care of perhaps an earlier retiring labor force. And the result of that, again, will build in significant expectations for high returns and will crowd out, I believe, the interest of others. So I'm not sanguine, I'm not optimistic that we could enter into a new paradigm in which we wouldn't be focused upon the returns to shareholders. I think that those demands will come up more and more. And so it is good to question the model. It subjects all theories to something of an acid bath. But at the end of the day, whatever regards to this acid bath, we're still going to find, I believe, the rusting girders of God against foreclosure. Thank you.
Okay, thank you for having me. Thanks, Lynn. One of the last times I was here at Cornell, I was taken from the ice hockey rink in handcuffs and to the cheers of thousands. Story for another time, but hopefully this will end better than that. I have to say, so some of you have the book in front of you. You know, a lot of times you hear people say, the author lost me on the first page. Well, I didn't even have to get to the first page before I was lost. Because on the cover, I know Lynn didn't choose the cover art probably, but there's a bear driving a bull off of a cliff. These are both hometown teams for me, so choosing between the Bulls and Bears, depends on how the season's going. But in this battle, I want the bull to win. I don't want the bear to win. I want the bull to win, right? We all want the stock price to go up. So I'm cool with the cover. But inside, there were some really good ideas, and some of my thunder's been stolen, but I'll just talk about some of the things that I observed while reading this. So there's three battles in corporate law. One is shareholders battling shareholders. And, she's on the term, she says here explicitly, she's on the side of long-term shareholders. Well, of course! Everybody's on the long-term side of long-term shareholders. That's Bill's observation, his question at the end of his great remarks. We only tolerate short-termism because we think it's instrumental to long-termism. And that's a question we have to fight out. It's an empirical one. Is an activist hedge fund that takes a position in a company and outs the CEO, is that something that creates long-term shareholder value? I don't know, maybe not. Your position on that, I think, determines whether or not you think an instance of short-termism or any short-termism is a good thing or not. So she uses in the book this example about dynamiting fish. Of course, if you're a fisherman and you use dynamite to fish, you can catch a lot of fish, but you're likely to destroy the fishing stock in the long run. And she equates the dynamiting fish to short-termism. I don't think so. I think if we had one firm who owned the entire lake, and their stock price of that firm depended on their ability to extract fish yearly from that lake, they're using dynamite would hit the front page of the Wall Street Journal and their stock price would plummet. So this goes to the question of how, I don't think, I'm from Chicago, so I think markets are mostly perfect. But even if you don't think they're perfect, you'd have to think they're really imperfect for the stock price of the fish company that owns the lake not to fall when they start breaking out the TNT. As I said, are activists bad? I don't know. I don't know what Professor Stout's end goals are. She talks in here, and I'll mention in a few seconds, about executive compensation. She thinks CEOs are paid too much. Well, there's a really great paper by some guys whose names are up there who say when activist shareholders, hedge funds, take positions in companies, one of the consequences is the CEOs get thrown out on their ears and their pay goes way down. That's a good thing. If you think CEOs are paid too much money, if you think CEOs are feathering their own nests and sitting in the corner office and flying on corporate jets, a little bit of short-termism might be a good thing. All of us, I'm in TIA crap. They send me a giant prospectus. I'm not sure why. I don't read it, even though I teach this stuff. It goes in the garbage. Most of us don't care what companies are doing because we're in index funds invested for 50 years. And if everybody took that attitude, then by goodness, we would have CEOs really feathering their nests because none of us are paying any attention. So I'm glad there's some guys that are paying attention. If you're somebody who thinks workers are being mistreated and you've got CalPERS representing you or a pension fund, then a little bit of activism there might be a good thing too. Okay, so I don't know. We'd have to ask ourselves, what's the ultimate goal? What are we trying to get out of this? And what are the most effective mechanisms for achieving those goals? If you think companies are too moribund, then a little bit of activism is a good thing. I saw recently that Jim mentioned Sweden, or Scandinavian countries. Among the biggest companies in Sweden, almost all of them were big companies in 1900. In the United States, none of our big companies were big companies in 1900. You think of the American brands today, none of them are RCA, right? It's Microsoft and Intel and Cisco and Apple. Those companies, Pixar, they didn't exist in 1900 because our entire economy is based on creative destruction. It's a very different kind of economic model. Okay, another battle, round two in the corporate struggle, is shareholders versus stakeholders. Both my predecessors mentioned communities and things like that, and Bill talked about complete versus incomplete contracts, and so this is sort of just a summary of that. I guess my observation there is I share some of the frustrations that Professor Stout does in the book about companies trying to, in the parlance of economics, externalize their costs onto others. So, I've flown from Chicago to upstate New York today. I have followed the pollution trail, right? There are Midwest factories that spit out smoke. They get carried in the wind. They landed on apple orchards in New York and denuded them. They took the Clean Air Act and the Interstate Compact about clean air to solve that problem. Everyone's in favor of that. But I don't want corporate law doing that work. I don't want managers of these factories thinking to themselves, boy, okay, let's consider the interests of the apple orchards, and let's consider the interests of the whales, and the bacteria that live on the vents at the mid-oceanic trail. I don't want them thinking that. I want them thinking, I want to maximize the value of this thing that I've got, this thing that I'm in charge of. And then I want robust regulation that says, when you externalize costs, you must internalize those so your process of deciding to maximize the value of the thing that you're deciding to maximize is socially an efficient thing to do. When we ask corporate law to do that, I worry about gumming up corporate law in a way that will make things worse. And I cite here a recent paper by these guys, none of whose names I can pronounce except maybe Shankman, who find that contrary to the normal expectation that people have, the companies who do a lot of good, they engage in lots of public good investment and philanthropy, they are not companies who do that and therefore then make a lot of money, right? Not doing well, making money, by doing good, but the other way around. It's companies who make a lot of money who then invest, like your typical philanthropist. I make it rich, like John Rockefeller, getting oil out of the ground and refining it, and then I create the University of Chicago. That's the model that really works in corporate America. Okay, the third battle is shareholders versus managers. And here the question is, who is likely to be engaging in more opportunistic behavior? As I mentioned, there's this question about short-termism, but on the other side, there's empire building. There's the nest feathering and the corporate jacks. Shareholders can be greedy and short-sighted, so can managers. I've saw in here, Professor Stout talks about, she says, business leaders accept without question that shareholder wealth maximization is the only proper goal of corporate governance. I don't think that's right. I don't think corporate managers think the only thing they're doing when they go to work today is maximizing shareholder value. I spent some time in boardrooms and with CEOs in a prior career, and that's not the way they think. To be sure, as Jim said, it is a metric. It is a very salient thing for them what the stock price is, mostly because they're paid that way, but also because it is society's best reflection of the value of what they're doing. But that's not all they think about. They think about their customers, they think about their employees, they think about the community that they live in. Whether or not all of that is instrumental to creating shareholder value, I think, is something that's like getting into biochemistry of love. But more or less, courts really have a hard time knowing whether or not managers or shareholders are being more opportunistic. In a series of corporate takeover cases in Delaware, the court said in one case, oh, the managers of this company have a long-term vision and therefore they're allowed to deny the shareholders a 200% premium on their shares. And then they said, whoa, wait a second, that's too much. That gives managers too much power to take money from shareholders. And so they came back home and said, no, you got to maximize. And this pendulum swings back and forth because there is no answer to the question, what is the optimal allocation of power within the corporation? You give it to shareholders, shareholders will abuse it. If you give it to managers, managers will abuse it. There are no saints in the corporate law game. And courts have to be facile in knowing and seeing the kind of indicia of opportunism to be able to allocate power accordingly. Professor Stout seems to think one of these potentials for managerial opportunism is in pay, and she thinks that that CEOs are paid too much, or the quote here from her book, stock-based compensation schemes have made executives wealthier over the past 2 decades. Meanwhile, average investors' returns have languished. And here she's kind of mixing two arguments we see about CEO pay. CEOs are paid too much and they're inefficiently paid. Here's a chart showing, this is a little bit old now, but I like this chart. This is CEO pay. The red line here is total pay. The blue line is cash pay. And on here is a quite influential article about CEO pay in Harvard Business Review that said the problem is that we don't pay shareholders for performance. And after this was published, we had and there were some other changes. We had a huge shift to CEO pay in stock, and CEO pay skyrocketed. And if we continue this for the last 7 years, if this laser pointer worked, but I'm really tall, right? This went way back up in 2008, and then came back down in 2009, and 2010, and it's back up now. I just saw the CEO of Walgreens, the Chicago paper this morning. I got paid $12 million last year. So that's about a typical U.S. company, and you can see right here, that's me, right up here. What's telling about this graph, which I think refutes a little bit of what Professor Stout was saying. Remember she said, yeah, the CEOs have gotten rich, but we've all paid for that. Well, the reason this red line looks like it does is because that's the stock market. That red line is the stock market. This is the Dow Jones Industrial Average overlaid on top of that. And if we continue this chart going forward, we would see the stock price rise and fall just as the stock price rises and falls. The reason CEOs have gotten rich is because they've presided over companies, and I've used the term presided there purposefully, they've presided over companies who have gotten way wealthier. Another cut of this. This is from 1993. This is average CEO pay and the S&P 500 for the exact same companies. If you link CEO pay with stock price, it's going to rise and fall with stock price. So in 2009, for instance, when the Occupy Wall Street movement was occupying Zuccotti Park and talking about the 1%, the take-home pay of the top 1% of the United States was less than it was in all 3 years of all the 3 last years of the second Clinton administration. And the reason was, in 2009 and 2010, we were in a deep recession. In the last 3 years of the second Clinton administration, we were in a huge stock market bubble. Pay and performance are quite tightly linked. And here's some data from my colleagues at the business school at Chicago showing not only has pay of CEOs risen with the stock market, but it's been tightly linked with performance. These are the compensation quartiles and 3-year performance. And so you can see this is the highest, the black bars are the highest paid executives, highest quintile, and they also happen to have the highest firm performance. I agree with all 3 speakers in a sense that shareholder wealth maximization is not legally required. You are never going to win a case in which you go in and say, your decision to pay taxes and not use a Cayman Islands shelter is unlawful and a breach of your fiduciary duties to us. But it's a sensible default rule, right? Gifts to charity, as I have up here, and incredibly stupid decisions are protected. But that's largely because it's just a question about incentives of litigation and our fear about courts making mistakes. Courts do police, just as they do in the other context, for opportunism by owners claiming that their actions are what's good for shareholders. A recent case is this one, eBay versus those guys, Newmark and Buckmaster, are Jim and Craig from Craigslist. They started this company that was like, you know, hippies and, you know, singing, you know, banjos, and everybody was doing the public good, and we're here to make the world a better place. And then they made a mistake. They took some other people's money. If you want to be, you know, a do-gooder, that's great, but you can't take other people's money and then try to spend their money to be a do-gooder unless you convince them to be a do-gooder with you. Jim and Craig took money from eBay. They started running the business in ways that eBay didn't like as a shareholder. eBay started doing things they didn't like. It generated a corporate battle, just like Dodge versus Ford. And Jim and Craig tried to put in provisions in the company that would deny eBay certain rights as a shareholder. And the Delaware Chancery said, look, you can't do it. It's great, it's fine. The corporate form is not an appropriate vehicle for purely philanthropic ends. Jim and Craig formed as a Delaware corporation, and having chosen a for-profit corporation, they're bound by fiduciary duties. The ink after the company made must mean at least that. In other words, it's okay if a company wants to make decisions that are not maximizing, as Bill said, shareholder value, but they can't take shareholders' money as investors with a promise that they're going to make them more money, and then say, oh, by the way, we've decided to run this business as an eleemosynary institution. We have eleemosynary institutions. They're called not-for-profit corporations. We have the ability for corporations to start companies in which they promise to act in ways that are good for the birds and the bees and the whales and the bacteria. But you can't promise one thing and then switch in midstream. So the real question is, what's our default rule? We can have a default rule. I'd be fine with a default rule that Professor Stout suggests, which lets boards maximize whatever they want to maximize, and then let people contract around it, so that shareholders could go to the board and say, you know what, we don't want to do that. We'd like to actually make money in the stock market. Or we can have one that says, you know, we can have a rule that says within board discretion and subject to the administrative costs of running a court system, you maximize shareholder value, but if you want to do something else, you can go ahead and do that. And there's lots of places that we can do that. There's all kinds of forms of business organizations, and my preference is to make these as clean as we possibly can so that there is actually a choice between them. If I know I'm investing in a corporation, I know what I'm getting, and there isn't the possibility that a court sometime later is going to tell me that I got something that I didn't pay for. Okay, I want to say one more thing, then I'll shut up. I do agree with Professor Stout that investors, and lots of us are, to use a word she uses, pro-social, meaning we care about stuff other than money. It's a common criticism in the Chicago School of Law and Economics that people only care about money. Economists talk about utility functions, not about money. Money is one component of every person's utility function. But there's other things in your utility function. Happiness, your enjoyment of the outdoors, feeling good about yourself, the warm glow you get when you help other people. There's all kinds of things in everyone's utility function. And it is completely rational for corporations to satisfy your utility function, not just give you as much money as you possibly can. So here's a paper I wrote with a guy named Milani. We call it the market for altruism. You have a bunch of individuals, and you've got the public good. You want to do good, you want to help people. That is as human a trait as we have. How can you intermediate your doing good? You, of course, could do good on your own. You could go and plant a tree. But if you want to intermediate it, if you want someone to help you, maybe get some economies of scale, you could have the government do it. You can pay taxes, right? We did a 1.6 trillion of that last year. You could go give to a nonprofit, and you can give your labor, you can give cash, or you can work for a nonprofit. Or you can intermediate your good through a corporation. And again, you could work for a corporation that says it's going to do things that are in the public interest. Google gives away 1% of its profits. Patagonia has a very sort of crunchy, we do good. You can work Ben & Jerry's before they sold out to their corporate interests. You go work there. And presumably they pay less. You could buy stuff from them, or you could be a shareholder in a company that gives away money to charity. All of these are mechanisms for intermediating your altruism, and all of them exist. There are plenty of companies who say they're doing things that are good for the public, and will happily take your money as an investor. The whole corporate social responsibility movement in investing is one example. This is a tiny part of total investors, which might tell us something about what people's utility functions look like. But putting that aside, you can invest in those funds, and you are necessarily, as a matter of economic logic, leaving money on the table when you invest in a socially responsible investment fund. But you're doing it because your utility function's got something else in it. In this paper, our only point is, well, first of all, we should think of this as a market for altruism, and all of these three entities are competing with each other to deliver altruism. And interestingly, the government is a special competitor here because it's also setting the rules for the other two. And when it sets the rules for the other two, it does so in a way that isn't really economically rational. These are the benefits you get in these 6 mechanisms for work, donating through a nonprofit or for-profit organization, and it depends. You don't get the equivalent government benefit, so to speak, by the different ways that you intermediate. If you buy a Starbucks fair trade coffee, right, that is identical to buying regular coffee and giving a donation to some Ethiopian farmers. And if you do that second thing, you buy regular coffee and you give a donation to Ethiopian farmers, you can take a tax deduction. But if you buy fair trade coffee, which is just a bundled product of coffee and a donation to Ethiopian farmers, you don't get a tax deduction. So in the paper we say, there's no good reason for this, and we should equilibrate these things so the competitors in the market for altruism are competing on equal terms. Okay. I'll end there. Thank you for inviting me.
Hi everyone. I just want to say thank you for coming, and especially thank you to these speakers. I can't tell you how honored I am to have our 3 guests here. And especially honored that whether they agree or disagree, they have taken the book seriously, which I deeply appreciate because some of the ideas in there are ideas that I think 10 years or so ago would have been difficult to convince people to take seriously. And also because of the nature of the book itself, which is that it's not a book oriented toward academics, it's a book that's oriented toward the informed layman. And I appreciate their tolerance in recognizing that and, tolerating the lack of footnotes, which some people find a wonderful thing, but law professors are not generally in that category. All right, so there were many wonderful comments. Of course, many of them disagreements, but that's where the fun is. And that's the part that gets me excited, because I look to the future and I see conversations about corporate law that have the potential to be much more interesting than the conversations about corporate law that have dominated the last 20 years, when there was this universal acceptance of what I view as a very narrow and potentially misleading agency cost model, where shareholders are assumed to be owners, principals, and residual claimants. I obviously don't want to try and address every point. I just want to touch on some of the most basic things. Number one, Bill, yeah, I think the answer is yes. If we frame shareholder value correctly, I'm willing to go along with that. Although I realized this as I was listening to you, you gave me an insight into my own book, which is that my discussion of residual claimants, some people might argue, inevitably puts me into the stakeholder camp. Inevitably. But I'm going to resist that for purely politically expedient reasons. I'm not ready to become an out-of-the-closet stakeholder theorist. I will simply say, however, that I don't think it is just a question of semantics at the end of the day. And the reason is because shareholder value on the ground, and by on the ground, I mean the way people in public corporations experience it daily as a pressure on their decisions, is not this broad, long-term, pro-social, diversified notion of shareholder value. It tends to play out, and not in all cases. I agree with you, Todd. I mean, there are plenty of CEOs and directors who will tell you that they are trying to think for the long term, and that they are trying to reflect their own shareholders' pro-social inclinations, not necessarily to be altruistic, but at least not to violate the law or to injure third parties. But the problem is, I also talk to CEOs and to people at lower levels of the firm and to people at boards of directors, and what I hear is a resounding drumbeat of concern that even though they'd like to manage for the short term, they face pressures that make that very difficult. Pressures like executive compensation that is tied to stock price. My complaint is not that CEOs are paid too much. My complaint is that their pay is paid to stock price, that defines performance very narrowly, and that after an initial run-up in stock price, we have hit a plateau. We are now we're long past the lost decade in terms of stock gains. We're entering the lost decade and a half. So it seems that tying pay to performance has not actually, at least in the past 15 years, improved performance. We're facing the first period in recorded history when bonds have outperformed stocks over the past 30 years. You would have done better by some calculations investing in T-bills. All right, so we have on the ground at least a concern that shareholder value, which could be read broadly to include concerns for long-term investor returns, for diversified shareholder returns, for pro-social investors' returns, is being read very narrowly. And this is showing up, I think, not just in terms of complaints by CEOs. One of my favorite surveys, there was a wonderful survey of 400 chief financial officers that asked the following question: would you decline a net positive value project if you thought it would make you unable to make your quarterly numbers? And 80% of the chief financial officers said yes. So it's not just that sort of information that makes me worry. I'm also worried about what I see as a long-term decline in the performance of our corporate sector, by which I mean public corporate sector. That's showing up in declining numbers of public corporations. The number of publicly listed U.S. companies has declined by 42% in the past 13 years. The number of UK public companies has declined by 50%. The life expectancy of corporations has declined. Fortune 500 companies in the 1930s had a life expectancy of 75 years. This is in the 1930s. Today they have a life expectancy of 15 years. Investor returns, as I've already mentioned, are flat and have been for some time. Now, you could say this is creative destruction, but my fear is it's destructive destruction, at least in some cases, and that it's coming from fishing with dynamite. And what I want to clarify with fishing with dynamite is I agree with you completely, Todd. If a corporation owned the lake and was blowing up its fish, of course it would fail. The fishing with dynamite analogy is supposed to remind us of the tragedy of the commons, where the basic problem is that we don't have a single corporation that owns the lake. The lake today is a metaphor for our total pool of investing corporations. And that is the species that is rapidly disappearing. And my concern is that the short-term behavior of activists who want to tie executive pay to stock price, usually measured in what they call the long term or over 2 or 3 years, but I view as a ridiculously short term when you look at the kinds of projects that corporations pursue. That those sorts of shareholder pressures, another example is a campaign that's been undertaken by a Harvard professor to get companies to de-stagger their boards so that they can be more easily taken over by activists who generally push for a short-term bump up in share price. And this has been very successful. We've seen, what is it, 60% of Fortune 500 companies have de-staggered their boards and thereby made themselves more vulnerable to takeovers. It's my concern that these are the sorts of changes that on a macroeconomic scale are causing our companies to be less able to make long-term investments, less able to survive and thrive, less able to make the sorts of pure research investments that lead to innovation, and as a result, less able to perform for those very shareholders that Jim mentions who want and indeed need decent long-term returns. So I'm going to finish up simply by saying I'm going to offer a critique of my own book above and beyond the ones you've heard. And I was surprised not to hear this one, but this is the critique. The critique is, all right, if we've got a problem here, what the heck do you propose to do to fix it? And Jim, in a way, came closest to that because he pointed out directors are terrible. And you're right, directors are terrible, just at least in the way that Winston Churchill once said that democracy was terrible. It was the worst form of governance except for all the alternatives that have been tried from time to time. But I'd like to do more than simply just say, let's return to the battle of managerialist days. It's true I'm nostalgic for them, but I agree with you, that may not be entirely realistic. So what could we do going forward to preserve what's valuable about the idea of the purpose of the corporation being to maximize shareholder value without encouraging the sort of dysfunctional and indeed in some cases marginally sociopathic behavior that this sometimes translates to. BP being a great example. I mean, BP has just been announced will probably be subject to fines of what, we're not sure the exact figure, somewhere between 5 and 20 billion, because it made short-term decisions that were foolish even by the company's own standards. But that's because BP was famous for feeling like it always had to make its numbers and pay hefty dividends to its short-term shareholders. All right, so what can we do? So I'm just going to throw out 3 ideas. The first thing is we definitely need to fix CEO pay. I'm not sure how to do it. Maybe the best way to do it is to get out of the business of inviting academics and bureaucrats to fix CEO pay. One of the most ironic aspects of the corporate governance movement in recent years is that many of the people who work on executive compensation purport to believe in law and economics. And I just want to remind them of Friedrich von Hayek, who said that one of the most important lessons of economics is that it tells us how little we know. And I'm not a big fan of central planning, and that includes central planning when it comes to figuring out how to compensate executives. Before the federal government got the business of, and by the way, that's where that spike went in share price. You know, the date in Todd's chart was in 1993. That's when the federal government required companies to tie executive pay to objective performance metrics in order to get, to supposedly get better incentives. So, you know, talk about unintended consequences. So if we really think that we get better decisions from markets and from individuals, let's get government and academics out of the business of telling companies how to compensate their executives. If we're going to focus on shareholder value, let's recognize the reality that different shareholders have different values. And some shareholders are pro-social. I actually think the total percentage of assets under management that are invested in socially responsible funds is now 13% in climate. Actually, it's 11% in the US, 13% in Canada. So it's not minuscule and it's growing. There are reasons that Einar Elhau at Harvard has laid out for why we actually should suspect that investor pro-sociality is even more endemic than that. But in any case, once we recognize that different shareholders have different interests, some are pro-social, some are asocial, some are focused on the short term, some are focused on the long term, I think we also need to recognize the reality that when we teach shareholder value ideology with a focus on today's share price, we are inevitably privileging the shareholders who are the most short-sighted and sociopathic. So maybe we can do some things to level the playing field. So I like, for example, the idea of a stock transaction tax. If you have to pay a sales tax these days when you buy toothpaste or a car or even a hip replacement joint, why should we not have a modest transaction tax on financial transactions? If we can't do that, let's fix the long-term capital gains so that we now define long-term holdings as held for 5 years instead of 12 months. Another great suggestion I just heard at a conference last week is time-weighted dividends. The longer you hold your shares, the greater the dividend you get. And this is something corporations could do on their own without need for any government intervention. But finally, the last thing we need to fix is the way we teach and talk about corporations and corporate purpose. Because the reason why the very sophisticated and nuanced conversation that you just heard is one Bill and I would agree. You would have heard a lot about it in like the early part of the 20th century, but it kind of disappeared between 1990 and 2000, was because the academic world itself embraced this very simple, elegant, and yet ultimately purely theoretical view of the way corporations work, and I think abandoned the sense of any need to see if that model actually generated predictions that could be empirically borne out. Because, of course, the empirical prediction of the classic agency cost model is, since we've had these steady improvements in corporate governance, we're now tying CEO pay to performance, shareholders have more power than ever before. Wouldn't you expect to have seen this great increase in corporate performance for investors? Instead, we've seen flat performance or even a decrease of performance, which makes me think that if nothing else, as we go forward as academics who are teaching classes, it's our obligation to talk about this question in a much more sophisticated and subtle fashion, this sophisticated and subtle fashion that our speakers brought to us today. So, thank you very much.